Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia Derivative in partnership with Phillip Capital and managed by our company LifeChamp. Today, we are very honored to be hosting the first familiarization webinar for Derivative Virtual Trading Challenge that is titled From Risk to Reward, the Science of Scaling Out in Trading. All right. So this session will feature two speakers, Jose Blasco and Brian Chan, whereby I'm the moderator for this session. Now, we will first begin with the first speaker, Jose Blasco, where he talked about from risk to reward, the science of scaling out in trading, whereby he will share with you his strategies in how to secure profit while protecting the downside, and how what is his methodology in getting out of a trade. Right, getting in a trade could be a methodological process, it's a science, but getting out of a trade is often an art because it involves a lot of emotions, right? There are regret, there are fear when it comes to getting out of a trade. And today he will share with you his secret and how he can strategically get out of a trade while giving a very minimal impact to emotions. Right. After that, we will be followed by Mr. Brian Chan, where he talked about Phillip Capital as well as what you can gain from Derivative Virtual Trading Challenge. All right. So we'll first begin the session with Jose Blasco. But before we begin, let me give you a bit of a disclaimer. Whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed derivative that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your trading risk. Now, allow me to briefly introduce our first speaker. He is a multi-asset trader who specializes in option, equities, futures, and currencies. Since he began trading in 2008, he has accumulated a wealth of knowledge on global markets, trading both directional and non-directional strategies across multiple time frames. In 2011, he began sharing his expertise as a trading instructor, delivering training in person as well as online and appearing on live broadcast events. Since 2018, Jose has developed innovative trading technology as a principal of Traditive Private Limited, where he also mentors traders worldwide. In addition, Jose has served as an engineering professor, and he taps into his love for technology to teach online trading techniques. His multilingual skills allow him to travel the world and keep abreast of global markets. So our speaker today is none other than Mr. Jose Blasco, all the way from Spain. Thank you so much, Jose, for joining our webinar today.
Thank you very much, Shane. It's a real pleasure to be here. Hello, everyone. I'm very excited about today's session. I'm very passionate about trading. I'm sure everyone here attending today is also very passionate about trading, and therefore my goal is very simple. I would like this session to count and help everybody to develop their skills to a better level wherever you are at, because I would expect that some of you have traded before and are experienced, some of you may be less experienced. Again, we're going to be working on different approaches to trading, and hopefully I can satisfy the needs of everyone. We'll have a Q&A at the end as well, so make sure that you type your questions in the chat box, you make note of your questions, so that way, whatever is it that I didn't cover that you need, I'll be happy to provide additional answers afterwards. So thank you very much. I'm very kind of you, Shane, as well, for introducing me in such a kind manner. Thank you very much. Anyway, so the title of the session, as said, is From Risk to Reward, the Science of Scaling Out in Trading. Before we even get started with the content and the practical applications, I want to throw a couple of questions out there, and I'd love if you guys on the chat box could give some answer to my question. Very simple question. I have two for you. One question, question number one would be, have you ever been in a trade that at the beginning of the trade, it started moving in your favor, but then suddenly turn around and stop you out, right? Have you ever been in that situation? So if that's okay, I'd love if you could have an answer for that, including if you are watching this session live on the YouTube channel as well. It would be great for me to see those responses. Exactly. And everybody's saying yes, right? This is exactly what I was expecting, right? Because the challenge of trading is that when we trade in the present, we are shooting for a future move, which may or may not happen, or may happen the way we predicted it. In other words, it's very common that sometimes we make a profit in trading, sometimes we make a loss, but to get to the end result of a profit or a loss, many times the market will play, let's call it, little psychology games with us, as Shane was mentioning, where the market may move in your favor for a while, then goes against you, and start creating some uncertainty or doubt, or even hurting the confidence level, which is a key component of trading psychology. So the beauty of what we're gonna cover today is that the scaling out techniques, depending on how they're applied, scaling out techniques could certainly bring in a lot of peace of mind to take care of those situations where the market was kind to you for a little bit, but maybe not all the way to your final target. And that way, we're going to be able to balance out the pros and the cons of trying to predict the future, which no one can, unless we have a crystal ball, which at least I don't. I don't have any of those. So therefore, it's all about managing the risk, which is going to help us to survive the trading game, to produce consistency in our results. And scaling out is a tool I love. And I'm delighted today to share with you my views and my approach for scaling out. Okay, so now that you know what's the plan, a bit of a disclaimer from my side as well. On the upper part of the screen, a very short paragraph that is being highlighted. Everything I'm gonna do is for educational purposes. So I will actually jump into live charts, identify live trading opportunities, and talk about the scaling out methodology that I would utilize in such setups. But again, all of this is for educational purposes. So this is not financial advice. And if you choose to take those trades, it's as Shane has said as well, it's your decision, okay? Which for sure, you can even use paper money accounts if you want to practice. Anyway, so agenda for today. We'll talk about what is scaling out, how to actually scale out, what happens, what is the impact on risk management, and most importantly, the impact when it comes to improving our win-loss ratio. The win-loss ratio is a measurement that tells us how often we win versus how often we lose. Then we'll talk about the impact on reward to risk ratio as an average, which means reward to risk ratio measures the ratio between how much you win as an average when you win versus how much you lose as an average when you lose. And of course, we want to maximize both the win-loss ratio and the reward to risk ratio. And we will understand better how scaling out can help us to, find a middle ground, which is going to be a happy midpoint where we balance out, the challenge of not being able to predict the future for sure every single time. Is that making sense? So risk management on top of everything. I have to say, I'm so excited to share that I have a bonus for all the assistants. Later in the latest part of the session, I'll talk about it. Basically, this is a tool that, in my mind, will be very useful for all of you to utilize. Later, I will be moving into live charts, utilizing TradingView, which I am now flashing on the screen. TradingView is a free software that everybody can use, and I'm pretty sure that many of you already use it. So if you don't use it yet, you could use it for free. If you used it already, great. And then what we'll do is that I will share certain tools that could be enabled on TradingView and help you with scaling out and trading in general, no matter your style. By the way, important, today's presentation, of course, I'm gonna be the one teaching it. So when I show you how I trade, it's gonna be the way I do it. But no worries over there, because the way I'm gonna be presenting how scaling out work is going to be in a way where it's gonna be explained in a way that is concrete enough, but also generic enough. Whereas if your trading methodologies are different than mine, you can still apply what I will be teaching, even though the way you set entries and exits and assess the trend and whatever it is that you do in trading, even if you do it different than mine, it will still be applicable, and you can still utilize those techniques. We'll have Q&A at the end, apart from a very important conversation with Brian as well, our other speaker, talking about the challenge and talking about Philips and tools and everything else. And when it comes to the introduction, I will just skip it since Shane has done a fantastic job introducing myself. Anyway, this was a little bit of getting organized. Let's begin. First things first, let's speak the same language. What is scaling out? Scaling out is a strategy that can be used for both long trades or short trades. And that strategy involves selling or buying back, depending if you're long or short, parts of a position as the market is moving in your favor. So let's say you want to buy a particular futures contract at this price, and you want to take profits at that price, and that's your final target. Well, yeah, you can certainly do that, which means no scaling out. You buy here, you sell there, and that's it. You buy 5 contracts, you sell 5 contracts, full position in, full position out, and that would be no scaling out, and that's totally fine. But today we're going to talk about what if in the middle of the move, after that market you traded is moving either up or down, long or short, what if you were to take partial profits along the way? That's what we call scaling out, and you're going to see why, and I believe you will appreciate it. So this method allows traders to adjust their exposure gradually, and can be applied as the price rises in the case of being long, or falls in the case of being short. So here's a first example. Again, I will first document the lecture, if you wish, using slides, so it's well understood, but then I will go back to real-time live charts, and we will do it again with live markets, okay? But basically what we have here is a screenshot of the KLCI futures contract. We have it here. This is the symbol on TradingView, FKLI1 exclamation mark. That's the symbol. And by the way, in this first example, I'm using 1D, which 1D means daily time frame. Every one of those every one of those candles in the chart is a day candle. Later, we will also look at intraday trading. For the ones of you who want to be more active, we will certainly talk about that too. So what am I doing here? Well, again, I'm doing multiple things. So there is a tool here in the bottom. There are those UFO flying saucers here on the top. So what is all of this? Okay, well, let's simplify it. I will explain it better later. But basically, the flying saucer UFOs, those UFOs, this is one of the tools I use when I trade. UFO stands for on-field orders. And when that UFO is red, it means sell on-field orders. When the UFOs are green, it means buy on-field orders. And therefore, another way for you to think of this is the sell UFOs are very strong resistances in the market, where the buy UFOs are very strong supports in the marketplace. So if you are a support and resistance trader, if you are a UFO trader, if you are looking to trade, even if you were to do breakouts, no matter what you do, you need to set your entries and your exits. And in my trading style, again, you could substitute my trading style with any other style. In my trading style, it's all about those green areas and red areas for me to enter and exit trades. We call them UFOs. They're cute, easy to remember. But again, it's very important because the green UFO represents a buy zone. So when the price comes touching and kissing the green UFO, that's where I want to enter. If I'm wrong, I will have a stop right below. And if I'm right, I will have a target right above, because the expectation is that the market, once the market enters the buy UFO or support, the support will push prices higher. And as the prices come to the resistance or the red UFO, then they would come lower. That's the expectation. That's where probabilities stand. And therefore, I will want to buy in the bottom part. I will want to sell, in this case, and take profits in the upper part. Okay, that's the plan in my mind. In this example number 1, which I'm kind of describing, just so we speak the same language. Okay, I will get deeper into everything one step at a time. So, entry set on the top of the green box, stop loss set on that little white space under the white box, target set using the opposing rival color UFO. Instead of green, we're using the red. In other words, scaling out, which is the topic for today, means that as we expect this move to go up, as I said before, right here, somewhere in the middle, in the white space, in between UFOs, in between support and resistance, in between entry and exit, somewhere in the middle, that's where we're going to exit a portion of the trade. Now, notice I said a portion. We need to talk about how big is that portion and why and where. And setting the right size and setting the right location for that exit would really, really help to do magic. Because if you were to scale out a random amount of contracts, if you were to scale out in a random position, well, you are basically subject to luck, just like anything that you would do in the market, which is random. If you buy, you close your eyes and you buy, you close your eyes and you sell, that's random. So then you're subject to luck. So here the idea is to become a systematic trader, having rules that actually increase your probability for success and consistency, which is what we are discussing today. So now that this is understood, we can see that in this particular case, congratulations, the move took place all the way. See, if you had bought there, this is what happened next. Okay, these are real screenshots, so this is what truly happened. So if you were to be the first trader guy that I mentioned that buy here with a stop below and a target all the way in the grid box, guess what? Congratulations. Okay, you were right on the trade. It went straight to your target, almost straight line going to your target. That's amazing. Well done. But going back to my first question of the day earlier, many of you said that you have seen yourself in cases where the market moved your way for a while and then turn around and now never came back and went against you. For example, you could have seen this move go up. It comes here to this candle where it went down. And now, instead of continuation and get to your target, you have seen, all of you, this market go like that. Okay, you missed your target and it stopped you out. And you were right for a while, but then you ended up wrong, which is sad. Okay, it's sad. And obviously, from a performance point of view, from a consistency point of view, if we could do something about it so we can avoid or minimize such situations, that it's the goal of scaling out. Okay, so the target was met, but you know, again, it's not going to be all the time. Okay, so before we get into how we're going to implement this, we also need to be aware of the pros and the cons, because again, in trading, every action that we implement will always have pros and cons. Why? Because we don't know the future for sure. Let's be humble. We need to be confident, but not overconfident or you know, arrogant. The market is the boss, not us. So we need to be humble, and because we need to acknowledge that while we have techniques and tools to improve our probability of being right, we are not going to be right all the time. This is where scaling out comes in with certain pros. There will be an alleviating factor when you add scaling out techniques to your trading. But every pro, like everything in life, also comes with a con. And before we get into how we're going to scale out, I need to go over the pros and the cons so everybody is positive on understanding and deciding if you want to implement scaling out in your methodologies or not, which I would think that, I mean, there are more pros than cons, so probably you will like what I'm about to say, but I do need to make everyone aware, as well as the downside of scaling out, because like everything in life, there are pros and cons. Okay. By the way, before I go there, a little bit of a feedback in the chat box, if that's okay. Would you mind sharing with me how is the lecture going so far? I know I speak fast. This may be a problem at some point. If that is the case, please let me know in the chat box. You know, hey Jose, slow down. I'm happy to slow down, not a problem. If it's going well, please let me know. All is good, and you know, you will make my day. Wonderful. Thank you so much. I'm serious. If I'm too fast, you guys let me know. Okay. I just said, you know, let's be humble with the market. Well, you know, let's be humble people, everybody, and myself too. So, you know, happy to adapt to you guys. Okay. So if I go too fast, let me know. No need to not to say it. And also we have a Q&A session at the end where if anything needs to be repeated, happy to do it. Okay. Thank you guys for the feedback. This is very appreciated. So pros and cons. Incremental closing. What does that mean? Well, traders close small parts of their positions at different price points as the price moves in their favor. What's the beauty here? Well, the beauty is a little bit of a psychological benefit. If you were to be a trader who never takes profit or only very seldomly takes profit, I'm going for an extreme here, well, what would happen to your confidence level? Your confidence level would be very much hurt. Whereas if you were to scale out, and therefore you take profits multiple ways during the life, multiple times during the life of a trade, what would happen to your confidence level? Well, because you get used to collecting profits incrementally, it kind of fits, that confidence level that we indeed need as human beings to click the button, especially in market conditions where maybe the market is volatile or something like that. And some people may feel like, wow, I don't dare to trade today, right? So again, everybody's different. And again, I assume, as I said, that in the crowd today, we have very experienced traders and maybe traders that are just in the starting stages or anywhere in between. And some of you may agree or resonate with what I just said. Some of you may not. But indeed, that the psychological part of trading is critical, right? Profit taking, by doing so, you are locking in profits at various stages, which, as I said, can be beneficial from a psychology standpoint. Risk reduction, it reduces the risk. Why? Because the moment, let's say you bought 10 contracts and now palm oil futures is moving your way and you close 5 of those 10 contracts you bought. So what happens? Well, you just collected profits, partial profits, with 5 contracts. That's item number 1 and 2. But what is item number 3 with risk reduction? Well, now you are left with a position in the market with only 5 contracts instead of 10. So what happens now? Well, now if the market was to go all the way against you and stop you out, your loss is going to be half of the loss you would get with the 10 contracts because you are only left with 5. So by scaling out, right, by unloading a portion of your position, you are reducing risk. Now, what's the downside? Well, the downside is if the market continues to move in your favor nonstop, then you get to your final target, congratulations. But then the net profit of the trade is going to be less. Why? Because you reached the final target with a smaller size. So of course, when you reduce the risk, you also reduce the reward. This is, again, this is, I guess, common sense. We wish it was otherwise, that you could reduce risk and increase reward. But obviously, in trading or in life, it doesn't work like that, isn't it? If you reduce the risk, you will also reduce the reward, okay? But you will also increase the amount of times you're right? So you will profit more often. While the size of the profits may be less, you will profit more often, and you are left with risk-free trades halfway into the life of your trades, which allow you to take multiple trades in parallel without increasing risk. Anyway, I spoke very fast there. That I have to give you that one. I was a bit too fast there. Let me repeat that at a later time in the presentation with examples, and you will get my point, okay? Because this is indeed very interesting. Before I go back to this, let's talk about how we do it, okay? This is probably what everybody's waiting for. Okay, now I know what is scaling out and the pros and the cons. How do I implement scaling out? Well, number one, there are a few things you need to know about your trade. Okay, increase risk, increase frequency of profit. Okay, Albert, we'll talk about this in a moment. Okay, good comment there. So what do we need? Okay, so you need to know what is your entry price. That typically when you trade, no matter if you are a retracement trader, a breakout trader, a Fibonacci trader, a UFO trader like myself, no matter how you trade, you know your entry price. But you need to know your entry price. Okay, you don't want to buy a stock or buy a futures contract and you don't even know the price you paid. Or short, and you don't even you don't even know the price you got. Okay, so this is trading 101. Okay, we need to know our entry price. What else? We need to know the stop loss price. Okay, and some may be thinking, oh, wait a moment, the way I trade, I use no stops. Okay, and then again, 2 words in the title of today's presentation is risk management. So again, this could be the subject for a whole lecture to talk about stop losses and why. But definitely, if you trade with no stops, there is a very big risk component. Today, I'm all about managing the risk, and therefore, I assume that everybody trading is using stops. Okay, and I'm not talking about mental stops, okay? Because some of you may say, I'm not using stops, but I know where's my stopping point. Well, remember, you may have that psychological impact when the market goes against you, and then you start hoping, and then you never exited at the price you said you would, because psychology acted as a trap, okay? So I am assuming that everybody understood all of this. Again, I could talk about stops for hours. I won't today, but I am assuming that everybody is ready to manage risk, and therefore a basic technique is stop losses. There are other techniques. Maybe you use options, you name it. I will assume today that everybody knows the entry and knows the stop loss price when you trade long or short. What else? You also need to know your trade size. When you placed an order to buy or short, you did it with 1 contract, 2 contracts, 10 contracts. You need to know your size. And by the way, we can talk about sizing for a very long time as well. It's critical, to be honest. I won't today because we have no time. But again, it's critical that we traders provide consistency. And the way you provide consistency is by risking the same amount every trade. If every trade you risk a different amount, I will do some writings on the screen very, very quickly. So if every trade you risk 1, okay, and 1 could be, 1,000 ringgit, 100 ringgit, 500 ringgit, you pick the number. I'm going to call it 1. If every time you risk 1 per trade and you lost 1, and you lost 1, and you lost 1, and let's say your average reward to risk ratio is 3, and the next trade is a profit, you made 3. So now, next thing you know, you are breaking even, which is not ideal. But this guy was wrong 75% of the times. And by being wrong 75% of the times, this person didn't lose money. It's quite powerful. Now, what would happen to a person who is wrong the same amount of times, but goes with a random trade size and a random risk per trade? So now the first trade you risk 1, the next trade you risk, I don't know, whatever, -4, the next trade you risk -2, right? And now next trade, let's say you make 5, every trade is random, okay? Well, what's the net result? Okay, well, as you can see, it's negative. Okay, and what's the problem? The problem is that now, the win-loss ratio means nothing. That 75% you were wrong means nothing because every trade is random. And therefore, it's basically impossible to produce consistent results if you randomize your risk taking. So the idea is with those 3 components, entry, stop, and trade size, you can create a consistent approach to risk. And once you have a consistent approach to risk, with scaling out, as you will see, you're gonna basically diminish the here we go. You're gonna basically diminish the risk that you originally took. Okay, and that way you can again run multiple trades in parallel and massage your trades and improve your win-loss ratio. So those 3 components are to be known. Okay, what else? Now that you know those 3 components, what do you do? Well, first you have to calculate the distance between entry and stop. So let's say you are planning to buy at 1,500, and your stop is 1,490. So the distance between entry and stop is 10. That's the distance. Distance between entry and stop. So we need to measure this vertical distance. We're gonna call it delta. Letter Greek D for distance. And then what you do is that you add that distance to your long entry when you're long, and you subtract that distance to your short entries when you're short. And what do we do next? This is my last step, and I'm going to show you that on the charts right now. What do you do next? Well, you close half of the position when you get to that scaling out price. Now, why do you calculate the distance this way? Why do you close half of the position and not more than half or not less than half? I will do the math in a moment and you will understand the benefit of doing it this way. Of course, you could, do this in a million different other manners, but you will see the benefit of doing it this way right now. So here's an example of an intraday trader trading crude palm oil futures in an 1 hour time frame. So here we're looking at a 1 hour time frame So this is an example with an intraday trader. The same thing would apply if you're a long-term investor with a weekly time frame. No problem. As I said, what I'm teaching you today, it's totally generic. It could apply to all methodologies, all time frames, all futures contracts, you name it. So what will happen in this case? Well, if you are a UFO trader like me, again, maybe you are not, but you are using support, Fibonacci's, Bollinger Band Pierces, you name it. In my case, my entry, which is one of the components I need to know, is 3963. Why? Because this technology is telling me 3963 is the bottom part of that red zone. So that's going to be my entry. Okay, then what? I need to find out my stop. That was the second component, right? We say you need to have three components: the entry, the stop, and the size. So I know my entry is 63. I know my stop is 91. Why 91? Because I want to stop above the red zone. The red zone is 90. So I go one tick above, which is 91. So 3963 to 3991, that's going to be my entry and stop. And then final exit, we don't need that now, but out of curiosity, is going to be 3846. Why? Because it's the green value. So I use the red values for my entry short. I use the green value for my entry long. Earlier, for my exit short. Earlier, I was using the green values for an entry long and the red values for an entry short, right? So instead of green UFOs and red UFOs, you can substitute these and be your support and resistance, Fibonacci retracements, Fibonacci projections, intraday floor traded pivots, pierces of Bollinger Bands. It could be buying a retracement into a moving average, you name it, okay? I will leave your trading methodology to you. I just want you to understand the scaling out project, and that no matter how you trade, entry, stop, and size, those are the values that you need to know. So what do we do at this time? Well, we calculate the difference. So 3991 minus 3963, it's 28 points, okay? So this trade risks the vertical distance of the red box is 28 points, whereas the profit zone, which is the white zone on the chart, right? Because the expectation is price will come into the red and then fall and go all the way to the exit. So if you risk 28 in order to make the difference between 63 to 46, right? 3963 to 3846. So this originally is a 4-to-1 trade. It's a 4-to-1 trade. You are risking 4 times less than what you would make if you're right. You are going to make 4 times more than what you are ready to risk. That's a 4-to-1. Okay, so I know my delta, which is 28 points. So what do I do with that? Okay, again, step 1, measure the vertical distance, 28 points. Step 2, for longs, add. For shorts, subtract to the entry. So let's do it. I'm going to take my entry, which is 3963, and I will subtract 28 points, giving me the value 3935, which is right there. Okay, right there. 35 is right there. Okay, that's going to be what I call my safety target. This is my scaling out exit. But I call it safety target. Okay, and you will see why I use the word safety in a moment. Again, the title of the lesson today is risk management. So you will see why I'm calling this a safety target. Some of you may be guessing it already, I'm pretty sure, but I will do the math for the ones of you that didn't think about it, and you will like very much my math, you will see. Now, the downside, if you recall, we said that when you scale out, even if you end up going all the way to the end of the trade, okay, which in this case it didn't, okay, safety target was reached, but the final target was missed just by a few ticks. Okay, the exit was 36, but we didn't go there. Okay, so it was missed by a little bit. And actually, we were stopped out at the end. If you did nothing about it, which of course, you may have risk management techniques. This could be the reason for another webinar. If you have risk management techniques, somewhere here, you may have something, you may have done something and exited somewhere here. But let's pretend you close your eyes and you did nothing. You would have been stopped out. So if you are stopped out, what happens? Well, you're actually breaking even. Why are you breaking even? Because you made 28 points. and you lost 28 points. Let's pretend you got into this trade with 2 contracts. So you were short with 2 contracts. Okay, let me do this so it fits in the screen. Short with 2 contracts. Good enough. Short with 2 contracts, right? So what happens when you come here? You close half of the position. How much is half of the position? You close 1 contract. So you made 28 points with 1 contract. In other words, you made 28 points. And what happens here? You are now left out of the original 2 contracts because you close 1. You are left with 1 contract, which means you lost 28 points with the remaining contract. In other words, you lost 28, you made 28 times 1, you lost 28 times 1. So the net P&L of the trade, once everything has been closed, it's a break-even trade. So this is why the proposal in this methodology on the slides, even though you can tweak it to your liking, of course, the proposal is shoot for a 1-to-1 target and unload half of the position there. Because by doing that, that target not only serves as a target where you get some money in, and is nice because it reinforces your psychology and all of that, it's actually removing the risk of the trade. If you scale out at 1-to-1 with 50% of your position, you just removed the risk. Assuming you have stops. Okay, that's the assumption all the time. So what happens if you remove the trade on FCPO? Well, you can now go ahead and take another trade in parallel with KLCI futures. You don't add risk to your account. If you take 2 trades in parallel in your account, you double the risk. But if you take trade number 2 after trade number 1 reached safety target, you are out of risk on trade number 1. So taking trade number 2 implies taking the risk on trade number 2 only. So you never add extra risk to the account. You always work with the same amount of risk. And now on top of that, you're running trades in parallel where when right, of course, there will be time where we're wrong, like the example on the screen, but when right, now you have multiple trades profiting for you in parallel, which will offset the fact that the original, sorry for that, not like this, the original reward to risk ratio that was 418, that original reward to risk ratio, I believe I said win-loss ratio. If I said that, it was wrong. Let me say that again. The original, let me show you that in the prior slide. So the original reward to risk ratio of this trade was 4.18 to 1. If you don't scale out, if you scale out, what happens now is that at 1-to-1, you take half of the position. And then if the remaining part of the position gets to the end, you make the full profit with half of the size. So with half of the size, you made 418, which is half of 418. And with the other half of the size, you made 1-to-1, which is 1 divided by 2, 0.5. So the net result is 2.59. In other words, talking about pros and cons, the beauty is that now trades that never meet your target may not generate a loss in your account. Now, trades that are still halfway into their life may allow you to get into additional trades in parallel without increasing risk in your account. So you can be more active with no more risk because you neutralize the risk of trade number 1 by scaling out at the safety target level point. What's the downside? You hurt the reward to risk ratio, but by running multiple trades in parallel, you will have situations where multiple trades may lose for break-even or a normal loss. And in cases when multiple trades profit, those profits are happening in parallel, offsetting the fact that the reward to risk ratio is hurt and creating a somewhere in between type of situation where now you profit more often. The losses you got are less problematic because many times your losses are actual break evens. And when you have a winning streak, those winning streaks pay you very, very nicely because it's multiple trades in parallel. So this is what we're talking about today. And probably this conversation now is clarifying a lot the title for the lesson, which I guess was pretty self-explanatory, but in a way, certainly is more clarifying. So anyway, before we move to the next section in today's presentation with Brian, I want to do a couple of things. I want to conclude my slide and jump into real-time markets. So I'm going to accelerate a little bit here. Impact on risk management. Scaling out manages risks. Half position milestone. Once the half of the position is closed at 1-to-1, the risk is removed. So you are in a risk-free trade position. That allows you for parallel trading because prior trades have no risk anymore. They have been neutralized. And it gives you a strategic advantage in the sense that you could now capitalize in trade opportunities more confidently because you know that as long as the market moves in your favor for a little bit, 1-to-1, you're out of risk. It's not a guarantee, but it's obviously easier to reach a 1-to-1 target than reaching a 5-to-1 target, right? Just because to reach a 5-to-1, price has to travel more and it takes more time and more things can happen during that time, news or whatever. And it's more difficult to make, it's more difficult to make 100 points versus making 10 points, correct? Anyway, so improved win-loss ratio. You should profit more often because your targets are closer. Impact on reward to risk ratio. Well, reward to risk ratios are reduced. That's the problem. But it's the trade-off. You reduce the reward to risk ratio that then, thanks to that, improves the win-loss ratio. And since you are going to run, or you could run multiple trades in parallel, then it's kind of like the trade-off is not even there. Okay, of course, that implies that, you are, let's call it active in the market. If you look at the market once a month, then of course you cannot take multiple trades in parallel. But then, probably you are not even attending today's presentation, isn't it? So again, this is a dynamic way on how to manage your risk that is very easily implemented by doing a simple calculation and closing half of the position. Anyway, so as I said, I have a bonus for you. Before I want to look for a real-time opportunity and we can discuss it. One or two, maybe we have time. I have a QR code ready. Get your phones ready to scan a QR code so you can get your bonus because in just a few minutes, I need to pass the floor to Brian. And therefore, I will give limited time to scan the QR code. So here's an example. Real-time markets. This is KLCA futures, daily time frame. And today, as we speak, the market closed inside of a green UFO. Well, of course, you now know I am a UFO trader, so you may agree or not agree with the trading opportunity I'm about to discuss, that this is not the subject for today's conversation. But if you are me, this is when I now start planning my trades because my expectation is price is going to move higher. And when it gets to the red UFO, that's when I close my profits. Okay. So how would I plan this trade? Well, I only need to know three things, right? What is my trade size? What is my entry? What is my exit? And then I need a calculator to decide where is my safety target. So the entry is 1614.5. That's the entry. The stop is right under 1599. Okay, right under 1599. So I'm going to make it 1598.5. That's the location for the stop. In other words, I'm risking 16 points. So if 16 points is my risk, my vertical distance, that's my delta, I just need to take that number and add it plus to my long entry, which is 1614.5. Okay, 1614.5. And that gives me the value of 1630.5. So in other words, my trade plan doesn't get simpler than that, is a plan by which I'm going to do this. my plan is to enter at this level. That's my entry, 1614.5. Right below is going to be my stop loss, 1598.5, as I said, at 1630. Right there. That's going to be what I call my safety target, where I will close half of the position, and my final target. Okay, so final target is going to be up there where the red UFO is, okay, at 1691.5. Now, today we are concerned about the safety target, right? The scaling out strategy. So when the market moves your way, as long as you come here, now, whatever it happens, even if you get stopped out, it's break even if you never reach your final target, right? So as you can see, this is something more likely going to happen. It's not a guarantee at all, but it's something much more likely going to happen than reaching the final target, which is located further away, right? And that's how you plan it. Now, one more example could be with all futures. And now let's do an example for intraday traders. So, of course, I done my homework before the session today, and I found and I looked for two setups where a trade is ready in the planning stage. Okay, again, this is not financial advice, as you know, guys. This is for education purposes. Okay, and if you like the trades, go for it. Real money, paper money, that's your decision. Large size, small size, that's your decision. But this is not financial advice. I'm explaining it for education. So what do we have here? We have a similar setup than before. Green UFO, that will be my entry, that will be my stop, that will be my final target. But today we are talking about scaling out. So how would I calculate scaling out? Very simple. I will look at my entry, 39.22, which is the upper part of my green zone. Could be a Fibonacci retracement line, it could be a support, could be the bottom part of a Bollinger Band, depending on your trading methodology. And then 38.89 is going to be my stop. So 38.89 is my stop. So I'm risking 33 points. So my safety target will be entry 39.22 plus 33 points, which is 39.55, which 39.55 is right here. So of course, in this case, as you can see, and that's why I got this example, by the way. This is the real world. Sometimes your safety target will be fairly close to the final target. This is typically the case in days where there is limited volatility, or time frames where there is less volatility, whereas, or markets that are less volatile, whereas in the prior case, if I go back to KLCI futures, okay, this actually has been a pretty nice volatile market in the recent times. I mean, you can see, if I zoom in here, I guess we all agree that, some of these daily bars, including today, look at those bars, pretty nice. Okay, it's not like other times where that market was not doing much. In recent times we got some volatility, and when there is volatility, typically, not always, but typically, your targets are further away. So again, that will give you a better reward to risk ratio compared to the trade with FCBO in the 15-minute time frame, but that's today. Tomorrow, next week, it's going to be different because each market, each trading day is different. Okay, but this is how you calculate your scaling out. And then the third component was the trade size. So entry, exit, and the trade size. So trade size depends on your risk appetite. Let's say you went with 8 contracts, then you take half, 4. Let's say someone asked, what if I went with 9 contracts? Half is 4.5. You cannot do 4.5. So you would take 5 contracts out at scaling out and leave the remaining position, to go to target. Very good. So that's how you do it. Would love to hear some feedback on the chat box, even though we're gonna have Q&A later on, but I would really like to hear a little bit from you. And as said, here's the QR code. So you have seen in some of the slides a tool in the bottom part of the screen called Auto Climate, which basically tells you about what's the climate in the market. Should you be a buyer or a seller? This is a tool powered with pretty intelligent technology behind it. Again, like all tools, it's just a tool. Your trading plan should either use it or not to use it, but this should be part of your trading plan. You don't take it blindly. You should be surrounded by trading rules and so on. Of course, you follow the instructions in the QR code. Make sure you use this coupon code called Claim8, so the tool becomes free. Okay, because on our website there is a cost, but with the coupon code Claim8, it becomes free forever. So you get it. But then once it's activated for you guys, you will receive a user guide, and of course you can always email our support team to know more about how to use it. Okay, but again, I'm pretty positive this is going to be helpful. And again, later we're going to go to questions, and I believe I am 1 minute late. Shane for to pass the room to Brian.
All right, thank you so much, Jose, for sharing with us your strategies in scaling out from your trade. I hope that all of you here have learned something from Jose today. So now we would like to transition to our second presenter for this webinar. He's none other than Mr. Brian Chan, who is the marketing executive of Phillip Capital, as well as a dual license dealer representative. All right. So Brian will share with you how Phillip Capital will help you to trade futures successfully, as well as how what are the benefits you can reap when you join Derivative Virtual Trading Challenge 2024. So without further ado, let me just hand over the session to Brian.
All right, now before I start, let me just share my screen real quick. I think Jose is still sharing it, so I'm not able to share my screen. Yeah.
Yep. Jose, you need to unshare your screen first. Yes.
Oh, okay.
Thank
Here
you.
we go. All right, let me share real quick.
Sorry about that,
Oh,
Brian.
no worries. I cannot complain since you gave such a great presentation on risk management. But yeah, now it's my part. So good evening, everyone. Thank you for joining us for tonight's session. And here I am coming here as a dealer and marketing exec at Phillip Capital. And in this part of the presentation, I'll be bringing you through the introduction to our company, as well as we will be running through the DVTC website together. So this part is important because once you enter the Bursa DVTC, you will also want to try out your trading in a live environment with live funds. Now, a DVTC is important because it gives you that push, that kick to kind of get into the market. But once the DVTC ends and you found that you're interested in the markets, you need to be able to correctly and accurately choose a good broker to put your funds in and to also trade with, right? So DVTC is a good practice and practice ground, and it will prepare you for the live markets in a way. So in this segment, I'll be bringing you through our company's background and why I think that we are a great choice for you. So first off, we have the boring but important disclaimer that this presentation has not been reviewed by the Securities Commission Malaysia and is only for educational purposes only, right? So if you do want to invest your money or in anything really, you have to consult a licensed financial advisor because investing and trading, quite frankly, holds a certain amount of risk. Hence, Phillip Capital and its partners are not liable for any investment decisions that you may make based on this presentation. All right, so moving on, finally got the boring disclaimer out of the way. Now let's look at our company, right? So first off, Phillip Capital, we're incorporated on the 7th of October, 1995, and we are actually a wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd. So big group, and we are a part of the Phillip Capital umbrella. Oh, I think I took a bit too quick. All right, so formerly, we were actually known as Phillip Futures because back then we only offered futures and CFDs. But actually, recently we actually added stocks into our portfolio, so we started to offer stocks as well, which is why we rebranded ourselves. We are a trading participant of Bursa Malaysia. We are a participating organization or org of Bursa Malaysia Securities, and most importantly, we are also a holder of the Capital Market Services License, which means we are legally allowed to offer you these products and services. All right. So here you can see that we have a lot of Philip offices nationwide. We have around 11 actually, Philip Investor Centers, as we call it, all across Malaysia, with our headquarters located in Kuala Lumpur. So we have physical offices all the way from Malacca, from Kota Damansara, Penang to JB, and in East Malaysia, we have Kuching, Cebu, and Kota Kinabalu as well. So if you are nearby any of these offices, and you want to inquire more on our products and services, feel free to drop by any of these locations. We do not bite, all right? So we have a beautiful, and I mean beautiful, track record. We have won many Bursa Excellence Awards throughout the years. Right here, you can see that we've actually won the Best Overall Derivative Trading Participant, Best Retail, Best Institutional, Best Trading Participant in Commodity Derivatives throughout the years, all the way from 2017 to just recently, last year, we won the first runner-up for the Best Retail Derivative Trading Participant, as well as the second runner-up for the Best Overall Derivative Trading Participant. So beautiful track record, as you can see here for yourselves, and this is a very beautiful trophy as well. Now, this should ensue some confidence in yourself for choosing us as your broker. Oh, I think my slides are gone. Let me reopen them real quick. I apologize for that. Sometimes these techie things happen. All we have to do is learn to bounce back. Let me just pull up my slides once more to where we were. All right. Let me share my screen again. Oh. One second. Currently it's loading. Wonderful night tonight. The weather has been kind of okay where I'm from. I'm based in Kuching, and I wonder if it's been the same wherever state that you're in. I hope it's been not too hot, but at the same time also not too rainy. Because I think now in certain areas in the world it is a rainy season. One second while I try to get my screen up and ready to be shared. One second. Yeah, I think I know what the hiccup is. Let me share it real quick. Once again, I do want to apologize for this hiccup. Okay, I think I'll just share it like this. Let me share it once again. Okay, I'll share it like this so it's a bit easier to see. Let me also zoom in so you can see it clearer, right? So first off, we have a global coverage, right? We are partnered with a lot of exchanges like Bursa Malaysia as well. We also have other exchanges like CME Group, Hong Kong Exchange, and Tocom and Eurex. And that's because actually Philip Capital, we are situated in around 16 different countries worldwide, right? The Philip Group is actually present in countries all across the world, right? Countries all the way from Western countries like France, Turkey, Dubai, to Asian countries like Singapore, Malaysia, Vietnam. So this is what gives us the access to these exchanges right here, right? So all of these products, if you want to trade any of the products here, you could trade them through us, Philip Capital. And Bursa products are actually very liquid. They are very volatile, which is great for both day traders and swing traders. So if you are interested in trading any of these products, you can do them through us as the broker, right? So we are your one-stop solution for your trading, and that's because we actually offer multiple products, right? We have futures, So index futures like the S&P 500, Dow Jones, right? Agriculture futures, metal futures like gold and silver, energy futures and interest rate futures, all the way to the good old stocks like local Malaysian shares, as well as foreign shares like US, Hong Kong, Singapore shares, and also to our contracts for different CFDs. We offer local Bursa shares, as well as NYSE, NASDAQ, and US index shares. So wide array of products, that cherry on top right there. So we are your broker of choice because first, we are an award-winning asset broker, right? We offer multiple asset classes, but also we are not losing in any part of the service department, right? We have the 24-hour broking and execution support. We also offer you advisory services and also the latest market news and updates, right? Which brings me to my next point, which is actually you can learn with Phillip Capital. Here we offer services like the free one-to-one coaching sessions, free seminars and webinars, as well as a free account opening process, right? So jumping in just a quick look on the free one-to-one coaching sessions, we will be bringing you through an introduction to futures or CFDs or stocks trading, right? Mainly focusing on the product knowledge. And next, we will also have a session on the platform coaching where we will be bringing you through our charting system on our own platforms, right? So we also offer our clients as well as everyone else, we have free seminars and webinars on the house. It's completely free of charge. All you have to do is just register and attend. And if you are interested in those events, you can scan this QR code right here. It will bring you to a page on our website where you can see all the upcoming seminars and webinars, right? And all free of charge. I'll stay here for around 5 more seconds and then I'll just move on to the next slide if you want to take a picture of this QR code. But don't worry, it's also on our website, flip.com.my. Okay, so moving on, we have the weekly market calls where on the left, you'll see we have a part for the market views and updates where we'll have an analyst present to you their weekly views every Monday at 11 a.m. And on the right, we have the live counter technical analysis part where you can discover weekly trends as well as potential entries and exits all on the house, right? All of these are free of charge, presented to you by our company's research team and our technical analysts. So if you are interested in those, do scan these QR codes here and you can have a link to register for them, right? I'll just stay here for around 5 more seconds and then I'll move on. All right, so here we have the online account opening process, right? So if you are interested in any of the products, you can scan this QR code right here. This is your portal to open stocks, futures, or CFDs, and they are all done online, which makes it really hassle-free because you can open it anywhere you want at your own convenience, right? At home or in the office. I mean, not in your office, but at home maybe, or in the car, or anywhere you want to do the account opening process, you could do it right here. It's extremely quick and easy and very hassle-free, right? But the strong point, I think, of our company is not just the weekly, research reports or our services, but also our platforms, right? And that's because this is our platform to trade futures. So we have Flip Nova, and this is actually a revamped application. We just revamped our application, and we have a lot of cool things on our interface, things like 90 technical indicators. You can buy or sell directly off the charts, and as well as the market depth trading tool. And actually, our interface for our charts are sourced from TradingView. That's right, we took TradingView's interface and we put it onto our Flip Nova platform because we think that it will increase the seamless charting experience of our clients, right? So if you're interested to try that out, you could scan for a demo account right here in this QR code. We have the platform on desktop as well as on mobile phones and tablets through the Apple App Store and the Google Play Store, right? So this is the platform, and actually here you have a chart on the trading view aspect of our platforms. So, actually, we are only one of the few, actually the only current Malaysian broker that has linkage with TradingView, meaning you could actually go on TradingView and you can trade through TradingView using our accounts, and not just interface, but also on the actual app itself. But you would have to actually purchase their essential package and also purchase the market data feed, right? But if you don't want to do that, you can have that interface of TradingView as well on our platform, Philip Nova. All right. So next up, we have our stocks platform, Poems Global MY 2.0, which is also newly refurbished, and it is also on desktop as well as the Apple App Store and the Google Play Store. So here you have it. Next up, we have the Flip CFD Trader, which is the platform that our clients use to trade CFDs. All right. Now, next up, we have everyone's favorite part. I love it. Like everyone, including me, we all love it, right? So promotions. We have the promotional section of our company. First, we have the trade CME micro futures with us, which means you can trade CME micro futures and earn up to around 1,500 plus ringgit in cash rewards. TNC supply. Scan the QR code there for more information. And you can also trade US index CFDs with us as low as $2, right? So you can also scan this QR code for more information. It will bring you to our website. But whatever I shared here can all be found on our website. So in case you missed it, you can definitely just go onto our website, which will be linked later on, right? So if you want to open an account, or if you want to know more about trading or things like the one-to-one coaching sessions, you could contact us through our social media handles, right? First of all, we are Facebook, YouTube, LinkedIn, and Telegram, right? We have all these platforms where we post our stock picks or stock-related news, or we also post our recorded webinars and seminars on our YouTube. We have Instagram, and we have our website, philip.com.my, where you can have all the information that I shared with you in my presentation just now, or quite frankly, right now as well. So here we have the branches contact details, right? We have the headquarters on the right side, as well as our email. And you also have all of these our branches informations right here. So Kuching, Klang, Melaka, KD, all of these you can contact and reach out to them right here. Okay, so that pretty much sums up my part. I can see some questions, but I'll answer them later on at the Q&A section. But in the next segment, I want to bring you through together with me to the Bursa Malaysia's DVTC website, right? So here you can just go to the bursamarketplace.com/DVTC, or you could just Google Bursa DVTC. Very, very simple and easy to remember. So first off, you arrive at this homepage, and really cool artwork. You can see everything's clear. The challenge period as well, from the 1st of August to 30th of August. So scrolling down, you still have time to register. You still have time to make up your mind and register for the challenge, because we still have 51 days left until the challenge officially starts, and you cannot register anymore, right? So first up, we have the how to participate, right? So the step-by-step processes are here. Right here, we can click here to register, and this link will bring you to the landing page. Let me just open it real quick right here, and you can just fill in these informations right here, all the way here. So moving back to the website, the good thing about people that don't know anything about trading is that DVTC offers you that push, because when my push was when my friends got me into trading, right? So if you don't have any of your friends that are interested in trading, this DVTC could be that push for you, because as Jose touched on the aspect of risk to reward, the risk reward ratio of entering the DVTC is literally exponential, because you have no risk on entering, there's no fees, there's no anything, right? But the rewards are that you could actually win cash prizes. You can win full day future trading workshops worth 4.8 thousand ringgit, as well as 1.2 grams of digital gold from Bursa Dinar. So here you can see the reward section, and all of these they could potentially be yours, right? They could be yours with a fee to register as low as zero, which is zero. The fee to join is non-existent. So taking from Jose, this is a crazy opportunity, right? It doesn't matter if you are afraid to lose money, because you don't have to spend money on this challenge, and you can see for yourself how you can, use your knowledge in trading to kind of perform in this challenge right here. And these are all of the prizes right here. And the best thing, not even the prizes are the best thing. The best thing actually are the webinars and the sessions for you to familiarize yourself with trading. So it caters to people that are both complete beginners and also people that are intermediate in their trading, right? They can join this trading challenge and join these webinars to familiarize themselves with the futures market, right? We have one more coming up on 19th of June, one more in July, two more in July actually. So these sessions will help you to get knowledge and access the DVTC right here, right? So this is the website once again. So we have Bursa marketplace.com/DVTC, and you can have all of the information here. But I kind of want to bring you through just a bit about how, why you should join. Well, first off, like I said, it's literally zero risk and all the rewards possible, right? You start with a virtual account balance of 100,000 ringgit, right? So it's demo money. It's not real money, it's demo money, but you are trading on a live market with real-time data. So you are trading live markets, but you're not risking any money, which is good, because you should not risk your money if you are new to trading or you don't have clear trading experience. You are supposed to use this DVTC challenge to sharpen your trading skills and identify market trends to make informed trading decisions. Once you get out of when the challenge ends, then you get into live trading with a broker like Flip Capital. So it has a competition aspect to it, which is this leaderboard right here, which shows you your ranking as well as the ranking of other people, because sometimes competition can be healthy and it can push you to bypass your limits, right? And I think the DVTC is a great friendly place for that, right? So coming back down here, we actually have the prize giving ceremony from last year, right? These are the winners of last year. So people joined, people traded, people won the prize, right? You can hear their stories and strategies in this YouTube link right here, right? So this is proof that people actually can take away a lot of things from the DVTC, right? And yeah, I think this is a great opportunity to get started in trading, because many people think trading is high risk. And quite frankly, if you join without prior experience, it is high risk. And I don't want you to waste and lose your hard-earned money, because money doesn't come easy. And I want you to take as much time to practice using the DVTC, using our webinars, and to try to challenge yourself to get into a new industry that you may not be familiar with, right? So remember to check out DVTC, and most importantly, if you want to know more about our products at Flip Capital, do reach out to me or any of the branches I listed previously, because that is going to be where you graduate from the I wouldn't say playground, but from a classroom into the real world. All right. So thank you for your time and your attention. I will pass it back to Shane to continue hosting for this session, and I'll see you guys in the Q&A section.
All right, thank you so much, Brian, for sharing with us Philly Capital's offering, as well as how DVTC can help you to become a successful trader. All right, so this DVTC is free of charge, and there's a lot of prizes, benefits for you to gain from this challenge. So if any question to ask any of our speakers, please write them at the Q&A box, not the chat box, so we can address them effectively. So the first question is posted to Jose. Would you consider the move the stop loss to entry price once the first target is reached?
Very good, thank you, and very good question. So yes, so really it's two different things, right? So the conversation that we had today about scaling out, it's basically it's part of phase one of executing a trade, which is when you plan the trade. Phase two is what happens when you are in the trade already, meaning the market met your conditions, you got filled, and now you are in a live position. So this is what we call trade management, okay? And now trade management rules, it could be depending on scaling out or could be independent or scaling out. So the answer to your question about trailing your stop, moving your stop or not moving your stop, really is an independent question. I would say not totally related with scaling out. It's all related, but not totally related in the sense that you could not scale out, but you could still benefit or potentially benefit from moving your stop as the market moves. As always, and as I discussed earlier in the presentation, every decision will have pros and cons. So what's the beauty of moving your stop? Well, if you move your stop, the beauty is that if the market moves, especially very fast, and then it's going to turn against you, then moving your stop and trailing price may put you in a position where you exit still for a profit, even though the market moved against you later on. So it's good. But also the problem of that is that sometimes the market, to reach a final target, needs to impulse and correct and impulse and correct. And some of those corrections may be deep. And if you move or trail your stop too close to price, you may be kicked out from a trade, and then you miss your final target because you actually move your stop. So the long story short is, if you ask me about preferences, I prefer to not to move the stop and instead use a scale out methodology, because by having your safety target in place, the moment you move there, you are out of risk. And then if I reach to my final target or I don't, I do not care. There is not a psychological pressure on top of it because I am in a risk-free position. So I don't need to move your stop, adding stress to my trade. Okay, so this is kind of like a preference. Whereas the answer to your question, I just gave it to you, and it's basically pros and cons. You may benefit from it, you may not benefit from it. I would suggest that you backtest it to see how well it works for you. But in my experience, especially if you trail your stop too close to price, you may be taken out of trades, and then now you never met your final target. So that's the pro and the con.
Thank you so much, Jose, for addressing the question. So the next question is by Ang. His question is, do we take profit the moment it reaches the safety target, or we only take profit when it goes beyond the safety target and reverse?
Yeah, the goal of safety target is to remove the way I position it in the presentation. The goal is to remove the risk of the trade as soon as possible, so you are in a risk-free trade, so then you can open other trades in parallel. Therefore, with this application, there is no need to wait for you to go through the safety target point and then wait for a retracement and then take that partial profit. Then you will just take partial profit the moment, with a limit order, the moment price gets to the safety target, you are out of half of the position, effectively neutralizing the risk immediately the moment the market gives you that chance.
All right. So if he hits the safety target, but you didn't manage to partially scale out, but it comes down, so would you take profit at a lower level?
I would not, because then you are not obtaining the benefit of what we mentioned today, which is removing the risk of the trade. If you close partially the trade at a lower price point, you will still have some risk in the trade, less risk, but still some risk. So just to be mechanical and systematic and maybe a little bit perfectionist, but also not to overcomplicate, my rule in this case would be, when I hit the safety target, I have a limit order waiting. As long as my limit order is filled, I'm out of risk. If my limit order is not filled, then I'm just waiting to either hit my limit order or hit my stop. Because let's face it, the original risk taken on the trade at the beginning of the trade is the risk appetite you have. So it should not feel like it's a problem to be stopped out. It's part of trading. The only thing you want is you want to maximize the cases when you get stopped out, where you have hit the safety target first. So your stop outs become break-evens. That's the goal. So you take the risk willingly, you accept the risk, indeed. So if you get stopped out, it's not an issue. But then you add the safety target to minimize the cases where a stop out equals a loss. Thanks to the safety target, stop outs may mean break-even. That's the very simple philosophy behind it. Of course, we can tweak it. You can get a bit more sophisticated and have rules, like, okay, if it reaches my safety target, then I'm gonna watch it manually, and then I move my stop, and if it keeps going, I'll follow it. But then you are adding a lot of manual action, which comes with psychology problems, in the sense that it will trigger fear or doubt. And again, the goal is not to maximize the profit for the safety target. That is why the safety target is called safety. The goal is to bring yourself back to safety, which is risk-free. For us to be in a risk-free position, we need to exit exactly at that price, exactly with half of the position. That's the philosophy behind what I taught today, which of course you could experience with variations, that's for sure.
Yep. So the idea is to make it risk-free. So the next question by Davey is that if the market move against my entry price the moment I enter, will I have double loss on this trade without a chance to scale out?
No, you will not have double the loss. You will have the predetermined loss. Like let's say you position yourself in a trade where you're gonna risk 10 points, and you go with 2 contracts. So you have the risk of 20 points of risk. And depending on what is the point value, which varies for KLCI future and FCPO or any other futures contract you trade. So you have 20 points of risk. Why? Because the distance between entry and stop is 10 points. You go with 2 contracts, so your risk is 20 points. You know that from the beginning. If that's too much for you, you don't go with 2 contracts. If that's too little for you, you may go with 4 contracts, and now your risk is 40 points. So you adjust the risk by adding more contracts or removing more contracts. This is trader's discretion. This is where we have control. That's the only thing we can control is risk. You do it by deciding the size. Once you have decided the size, and let's say it's 20, you know your risk is 20. If you get stopped out, you get 20 points of loss. If you get to the safety target, you make 10 points, which is half, which means that if then you get stopped out, you lose 10 points, which puts you in a break-even position. So in other words, if you don't hit the safety target and you get stopped out, you get the loss you were expecting to get. If you do get stopped out after hitting the safety level, you get a break-even trade. Those are the 2 possible outcomes.
All right. Thanks, Jose. The next question for you is by Maslan Yusuf. Which is the best trading method to determine the entry price for scaling out trading? Which of these methods have you used in your scale out trading? Is it support resistance, Fibonacci, moving average, Bollinger Band, or any RSI methods?
Got you. So really the calculation, because the question is about to determine the entry price for scaling out. So the entry price for scaling out, it's really the entry price of your trade. So there are millions of trading methodologies out there in the world. All of them, have, again, I'm gonna go back to pros and cons, because again, that's the case. There are certain methodologies that work amazing when the markets are volatile, but you never know when the market will become quiet. There are methodologies that work very well when the market is quiet, but you never know when the market will become volatile. So again, all methodologies have strengths and weaknesses, like vehicles, like cars, like everything in life. So whatever methodology is the one you use, your entry price is dictated based on that methodology. My preference is UFOs. That's what I'm using on the screen. That's what I was using on the screen earlier when I was sharing screen. This is what I use in my trading. So UFOs is my favorite approach to trading. It's not the only one, and there are many other approaches to trading that are very valid. Again, all of them with pros and cons. I find that with UFOs, you have a little bit extra precision, and extra precision means better win-loss ratio, and that at the end of month, at the end of the year, may mean better profits depending on how you trade, depending on the other rules. depending if you move the stop, if you don't move the stop. Again, it's all about your trading plan in the end, right? So that's how you get your entry price. Your methodology dictates your entry price. Now, how do you calculate the safety target? Mathematical calculation as covered today on the slides. You look at the entry price and your stop, you calculate the vertical distance, and you project the vertical distance, same distance above. It's a 1-to-1. Your safety target is same distance from entry to stop, same distance projected above or below, depending if it's long or short. So your safety target is 1-to-1 away from your entry, and you close half of the position. By exiting at 1-to-1 and closing half of the position, you create this mathematical benefit where the trade now becomes break-even. Worst case is break-even, risk-free. That's why it's calculated this way. You can do it in a million other ways, but this way is convenient because it's easy to calculate. 1-to-1 is easy to calculate. You can project it fast. You have your safety target there, and half of the position puts you in a position of risk-free, which allows you to take other trades in parallel. That's the goal, and that's why I presented it this way.
Thanks, Jose.
Thank you.
We have a few questions being posted to a brand. The first question is by Lee. For retail investors like us, we can see only 5 levels of buy and sell Q, right? For example, FCPO and FKLI. So his question is, how many buy and sell levels can institution participants see in your platform? Like, what's the market depth?
Okay, thanks, Lee. So regarding your question on the how many levels can you see, it really depends on the platform. For Flipnova, it is 5 for buys and sells, and it's the same regardless of if you are an institution or if you are a retailer. So largely, this applies for every platform as well. It really depends on the trading platform. So if retailers use other platforms that offer a higher price, which gives you more of a market depth, then they are able to see more buys and sells at different levels. But for Nova, we can give 5 buys and 5 sells, and the institutions see the same levels that you see if they use Flipnova.
All right, thanks, Brian. So the next question is by Lee May is, what is the difference between Flipnova and Philip CFD trading? Are they 2 different accounts or they share the same account? And how about
So Flipnova is our platform that clients use to trade futures only. Flip CFD Trader is the platform that our clients use to trade CFDs. And with the way that the laws and regulations are structured in Malaysia, you actually need to open 2 separate accounts for future trading and CFD trading. So 2 separate accounts and 2 separate platforms for 2 different products.
All right, thanks, Brian. So let's do one last question. This question is meant for Jose. This is asked by Royan. Do you have a minimum risk reward for this scaling out strategy? For a R&R of 2, with scaling out, will it become 1.5?
Correct. Very good question. I love the questions, guys. I'm enjoying this session very much. Thank you for that. So yeah, definitely. In my trading plan, 2-to-1 is my minimum. Funnily, exactly like you have stated on your question, 2-to-1 is my minimum. But in general, what I would advise everybody who is exploiting a trading methodology, like let's say you are getting ready for the challenge, you are putting a methodology together, you are designing your rule set. So what you would want to do is to do some backtest. Go back in time and backtest market opportunities. Why? Because in life and trading, because the markets are the real world, so life and trading is the same. What happens is that typically quality and quantity does not come together. In other words, you have many trades out there that are 1-to-1. You can take those all day long, especially in the intraday timeframes. But only a few times the market will give you 3-to-1s and 5-to-1s and 10-to-1s. That will happen less often, right? So it's quality and quantity, like in life, right? You have many places where they do, amazing nasi kerabu, for example, but only a few places in the city are very unique, right? So quality and quantity. So think of your trading this way. And why am I saying that? Well, because in the end, what you want is to produce the greatest performance as possible for the challenge. So if you were to shoot that, let's say you have a rule that says, okay, my minimum is going to be 5-1. And I know my 5-1, or like the example in the slide, 4-1 minimum. I know my 4-1 becomes 2.89-1. I believe it was the metric, right? So you may say, I want minimum 4-1 because that way I get 2-1. Okay, great. But also know that the amount of times you will have 4-1s is less often compared to the amount of times where you may get 2-1s. So in other words, a trader doing 2-1s, they may end up with a net reward to risk ratio of 1.5-1, but they may trade more often. And therefore, at the end of the month, at the end of the challenge, you actually made more. So it's a balance of quality and quantity. It's just like many other things in trading where you have to decide something for yourself. It's like, okay, which time frame do I use? The daily time frame or the 4-hour time frame? Or do I use the 15-minute time frame? What do I use? I want to risk 1% per trade or I want to risk 2% per trade. Well, what is your minimum reward to risk ratio? This was the question. Well, mine is 2-1. Why? Because it works for my plan, given what am I trying to accomplish in the marketplace. Now, if you are doing a challenge and you want to perform at the maximum, so again, you may want to do a little bit of backtest to conclude what is the most convenient number for you, given your methodology. Maybe you're a Fibonacci trader, and an ideal number is 3-1. Maybe you are a Bollinger Band Pierce breakout trader, and maybe your ideal number is 2-1. So you want to backtest it to find what's your number, knowing that you always have pros and cons, which I repeated many times in the presentation today, the pros and cons thing, because my friends, this is life. It's how it is, and that's how you need to come up with your rule set.
All right, thank you so much, Jose and Brian, for addressing the Q&A session. So thank you everybody for tuning into this first familiarization sessions of DVTC. So if you're new to futures trading, and definitely encourage you to join Derivative Virtual Trading Challenge 2024. By joining this challenge, you'll be able to practice futures trading and also practice the strategy that Jose shared with you. How do you skill out in a trade? And of course, we also hope that you can pick, Phillip Capital as a broker partner in this DVTC. So with that, thank you everybody for joining this session. So you're just listening to Jose Blasco, who is the principal of Tradictive, as well as Mr. Brian Chan, who is a marketing exec of Phillip Capital. Thank you so much, both gentlemen.
Thank you so much. Real pleasure. Thanks everyone for coming today.
All right.
All right. Thanks, guys. Bye.